Welcome, everyone. Well, obviously, not that many of us want to hear about being taxed on our cryptocurrency, but I think this is going to be an incredibly informative discussion. Also, if you didn't pick up one of Naveen's white papers, please collect it at the front, and that's also on cryptocurrency taxation. So I'm really looking forward to this panel. It was hard work pulling together such experts, and I'm really pleased to have them. And I'm going to pass this over to Sheila, who's moderating. Sheila's involved in the FinTech community, and she's going to moderate the panel, and she'll introduce everyone. Thank you.
Thanks, Emma. Welcome, everyone. Good to see you. I think there's a little bit of a less turnout than normal at Pamela's event. I guess people won't pay taxes. That's why they're not here. I don't know. So 2018 is a critical year, I think, unless some of you, had a tax event last year for cryptos. Just a quick poll. How many of you have traded in cryptos and are due to pay taxes this year? Did you guys pay any last year? Anyone paid last year, 2017?
I think they were scared an Irish agent might be here and showed up.
Yeah, but since the payment plan for that, in case the IRS, you won't be able to play it. I know somewhere where some people actually bought cryptos and didn't actually look at it, and then finally, when the price went up, they realized, oh my God, I have to pay so much tax. So that might happen too if you are not looking at your pricing. It's probably going to be a bear market this year, so maybe that's a good thing, for us. But anyways, we have a lovely panel here, experts. I've been interacting with them. They put in a lot of thought and preparation to this, so thank you guys. Appreciate you also coming a long way. Some of you from Sacramento, Sonoma, I don't even know, San Francisco, still pretty far, I would say. So appreciate them too. So let's take a quick minute and introduce ourselves. Maybe say your name, what you do, and whether you're the buy or the sell side. Nice to meet you.
I'm John Van Loo, and I am a tax lawyer. A firm based here in Silicon Valley, and most of my practice right now is really working with cryptocurrency clients, kind of equally divided between buy side and sell side clients doing ICOs and some fund investors. I also do a variety of other transactional work, M&A, including M&A. And recently, actually, we just finished an M&A against Coinbase.
My name is Dmitry Alexeyev. I'm a director, tax director at VPM. We're a CPA firm, 40 partners, more than 500 employees. I've actually been in the financial services space for over 18 years, and we've personally started doing the work in the banking and space, and moved into FinTech, and then technology, and then to FinTech, technology, and then crypto and blockchain. And I've actually been doing this since 2014. And so, actually, personally, relatively new to BPM, but BPM is one of the leaders in, we serve many different clients, hedge funds, miners. We also work with ICO companies, pre and post ICO companies, and provide accounting services to them. So we are very active in this space, participate in the community, and collaborate with many different professionals, charities, investment interests, hedge fund managers. So I'm happy to be here. This is a great panel, and looking forward to having this discussion here. And thank you for being here today.
Hello, everyone. My name is Navin. I'm with EY, which is one of the big four accounting firms. My background actually started off as you can tell, I'm not from around here. Yes, I'm from Texas. Grew up there. Started off my career as a tax attorney down there in Houston for a couple of years. Moved out to the Bay Area about 20 years ago. Right now, I focus at EY in our financial service sector. So most of all my clients are hedge, venture capital, private equity. I do kind of the tax consulting and structuring for them. How I got into the space was about one of my hedge clients came out to me about 4 or 5 years ago, said I want to invest in Bitcoin instead of a fund in it. I said, great, let's do that. What is Bitcoin? And that's kind of what we've been going on that for the last few years, and that's what got me here.
So yeah, I think some people still getting to know Bitcoin. So I think this panel, just know that it's not about the basics of Bitcoin or buying or pricing or issuing a coin. It's all about tax. So just maybe towards the end, if you have time, we'll look at the future of crypto and things like that. Let's see if you have time. So John, maybe perhaps since you're both on the buy and the sell side, you can give us just an overview, of taxes and issues related to taxes and markets in crypto.
Yeah, sure. So as a tax attorney, I have a very specialized role with my clients. So I'm really there to like Nathan kind of described, help them sort through the different possibilities for structuring transactions and issuing tokens and describing the tax consequences of doing their transactions in different ways and helping guide them to the transaction that's going to, the structure and the form that's going to get them the best tax treatment and also kind of avoid pitfalls. And I mean, there are a lot of different issues that I think we'll have a chance to sort of talk about in more detail. But I think in broad terms, the biggest ones that I see are, first of all, timing. Timing of income is a big one, especially on the sell side. Something that actually I haven't really seen discussed that much. I think that will be a bigger issue as time goes on and more people start having to file returns and things like that. On the buy side, and the investor side, I think we see more products, basically, more different kinds of investments, especially in the early stages. And I think part of this is not really tax driven; it's really more driven by securities law issues and other things.
Would you like me to? Yeah, sure. So, actually, there's a lot of different things happening, and to me, this is actually very exciting. As a tax professional who's been doing this for a long time, we get to look at issues that no one actually looked at before. So when I talk about it, I actually get really excited about it because, it's just like back when I was a young professional, go back to the code and you try to read through it and try to figure out what the answers are. There's two schools of thought right now. One school of thought will say, well, we don't have a clear guidance from the IRS or regulatory authority, and so therefore finding the answers is extremely difficult. And the other side will say, well, we kind of have the laws on the books, it's just a matter of interpreting it. And it's like the moon and the sun, right? So whatever comparison you want to use it. So I think both are right, but we clearly need some guidance. We had notice 2014-21 saying that virtual currency is property. Other than that, we didn't have much guidance, and we're obviously getting different signals from the regulators. The Chairman Clayton made statements in December of last year about what his thoughts were about virtual currency and whether or not the tokens are securities, and then the Commodities Exchange regulator came out and said that cryptocurrency, virtual currency is a commodity. So we're getting different signals from the regulators from and it's right now there's a lot of different issues that we have to work through, and you're absolutely right. A lot of the focus was, you and I talked about this before, is a lot of the focus is on the regulatory, not necessarily on the tax side, but whether or not you're doing the buy or the sell side. I think what matters, and I think what the biggest takeaway from everything is facts and circumstances matter, because if you're looking at the ICO, if you're looking at the blockchain company, you have to look at the business and what the transactions are. And the transactions not just at the company level, but also the transactional stakeholders and the entire ecosystem. Because if you don't understand the facts, it's very, very hard to come up with tax answers. Honestly, I had a meeting earlier today with a prospective client. We talked about their business and what they were trying to do, and frankly, a lot of the issues that they're dealing with have nothing to do with tax. It's just they're trying to run a business. That's what they're trying to do. But it just so happens that they want to stay compliant and do the right thing. And I think doing the right thing and surrounding yourself with the right professionals, no matter who they are and where they come from, I think is really important, because not having an A team where you have so much uncertainty is bad. So.
Sure. I mean, at the end of the day, as a tax practitioner, right, a person that's going to sign a tax return that a client's done, I'm looking at both my risk when I sign a return, as well as my client's risk when I take a position, tax position. And I think we kind of stated already that the SEC says, oh, these are securities, we're going to govern them. The FTC says, no, these commodities, we're going to govern them. All right. Well, the IRS is the one I follow, right? They've said so far property. Okay, there's a lot of case law, there are rules out there on property. It says that, hey, if you have property and you sell or dispose of it, you need to know your amount realized and your adjusted basis and figure out the gain or loss, right? So that's my starting point, and that's where I go from. And also my starting point again is that, okay, it's taxable unless I can figure out a way that it's not, right? So I think those are as a practitioner, the ways I work through the problem. But I agree, there's some people saying one way or the other, but that's kind of the premise I start with, and then I kind of go from there. And I do agree that we're kind of looking at it from a brand new angle. We're looking at a new world and trying to put into archaic rules, which never thought about some of these situations we talked about. I think John and I were talking about new things that our clients are doing and new products are coming out here. And I said, okay, great. I don't even know what this is. You got to explain it to me again. And we got to figure out what the tax issues and the implications are. I said, but that's kind of the overall approach I've been taking with my clients, that, okay, this is our starting point. This is the notice from the IRS is the only point of reference we have. So let's build off that. And that's kind of basically the approach so far I've been taking with my clients in this space.
So you want to give us an example, or maybe perhaps without naming
Sure,
names or anything?
Exactly. So again, I'm more on the buy side, so people have investments. And so again, most of my clients are funds, right? Those that actually are pooling money together to invest. But also a lot of these same issues apply to the individual level as well. So a simple example, right? A wash sale. So there's a tax rule in a wash sale that if you buy a stock security, you sell it for a loss, and you get economically right back into it, you have to suspend the loss. Because you really didn't, it's not a real loss, because you got right back into it, right? So that's the code section there for securities. So does that apply to crypto? Well, the code section says it applies to stocks and securities. Well, IRS has not said this is a security. So it's only property. So there's an argument there that, okay, this wash sale rule that's there to suspend, let's say, economically created losses, doesn't apply to our world, okay? That's a relatively good answer in that respect, right? But then you have other things, right? There's, for our clients in fund world, they have to, they trade on different securities for their clients. There's an exception out there, right? Without getting in detail, that allows them, that if they're trading on basically on their own behalf, right, then they don't have, it's not considered trader business, and there's no withholding if you have core investors, okay? So there's an exception out there, rule's been out there forever, almost all my hedge fund clients, they use that rule, right? But that rule said, this rule applies if you're basically trading on stock securities, commodities, things like that. Well, again, it's not stock or securities. So if I have a fund and they have foreign investors, I say we may not be able to fall into this exception that's there that we traditionally always use for hedge funds. So what does that mean? So that means maybe I need to withhold on any income, all income allocated to any foreign investors, because this exception might not apply. And that's when kind of John said that we start thinking about structuring that. Okay, how do we, if this rule does not apply, we don't have any guidance, but let's assume it's not a security and a commodity, so it will not get this exception. How are we going to structure around this if you want foreign investors into your funds? So literally every single rule out there, investment rule out there, you have to look at it again in this whole new world to see whether it applies or not. And those are some of the complexities that come out.
Can we jump into a question?
Sure, absolutely.
Yeah, two questions. I didn't understand the constraints created by the presence of foreign investors. That's the first one. And then the second, couldn't you, a lot of these cryptocurrencies are correlated. Couldn't you just jump into a correlated currency for 35 days? I forget. Is it
30 days, yeah, 30 days before or after. 60-day window around
the 60.
Did everybody get the question?
I'll explain the tax issue. So kind of taking.
You might want to repeat the question for you.
Sure, I'll definitely do that. So the first was just how the foreign investment person works, right? So right now, if you have a foreign investor in your fund and you sell stock and it has a gain, you don't withhold on that gain. You just allocate it to foreign investors like any investor, and then they pay the tax in their jurisdiction, right? Okay? The only withholding is out there is on dividend. That's the only one that's out there. The reason why we don't withhold on the capital gain is because of this exception. This exception says, hey, you're trading on your own account, and the code section says that if you're doing this, then it's not considered trade or business income, and you don't need to withhold on it, okay? So that exception is there. It's pretty much most people don't even think about it because that's the way it properly applies, right? And so typically if I sold IBM for a gain, allocated to my foreign investors, they just get their share. In this world, if I buy Bitcoin and sell it for a gain, that exception may not apply because it only applies to when I buy and sell stocks and securities. So that doesn't have, when I allocate my gain to my foreign investors, I may be required to withhold and remit the tax to the IRS.
I thought it was everything but real estate.
On this piece of it?
Foreigners.
For foreigners. That wouldn't know. So you mean the exception? The FIRPTA. Yeah, so it's FIRPTA, but also there's this exception for trading in stocks and securities. So FIRPTA is kind of another piece of it as well.
Just to clarify, so this is actually when you have an office with investment professionals who are going to work every day in New York, an exception that they will not be considered to be operating a trade or business in the United States, that the U.S. has jurisdiction to tax. It's an exception for that situation.
So if I were sitting in Moscow, I'm not a resident of the United States, and I'm buying some cryptocurrencies through an account in the U.S., and then I sell them for a profit, do I pay any tax on capital gain?
So are you talking on stock securities or talking about crypto? That's a good question. Yeah, do we have an answer for that?
Describe it.
I'm not a resident. I'm abroad. I have an account in the U.S. It's probably not reporting anything back home, which is, let's say, Moscow. I sell cryptocurrency in the United States in my account. Do I owe any tax on my capital gain?
I don't see any U.S. connection there.
Just like stocks.
But if you invest in a fund that has 10 folks in Silicon Valley or New York or wherever they may be that are trading,
so if I'm
that's
Americans, I have a problem.
Yes.
Well, I mean, that's the word for it. Where's the line, right? He has someone that works for him, represents for him here, has a little, sign on a door. You're going to create yourself some kind of individual LLC. Where's the line now where he has a presence here where he may have a problem? I think there's a point that he's going to have a problem. If it's purely outside, I don't come to this country at all, it's just I'm using exchange here, probably okay. But more and more activity, I think, could cause some concern.
Yeah, I mean, the other thing too is that, thank you. I mean, the other thing, the exceptions that we have on the books currently that were not designed for virtual currency, a lot of those exceptions were designed so that it could promote the investment here in the US. And so, because, if you look at the tax code and the evolution of the tax code, I would even say, since 1986, a lot of it was done to promote foreign investment in the US. That's the reason why you have all these different exceptions to the rules, because again, they wanted to have the inflow of foreign money into the US.
So I thought it was the exact opposite. I thought it was always foreigners could invest here without paying taxes on capital gain. And then the Japanese scared us, so we even referred to.
Well, it's kind of hard for us to get into the policy decisions here because, so we can talk about tax, but at least the theory has always been since the 1980s is that promoting the U.S. as one of the friendlier jurisdictions, especially when it comes to taking foreign money.
I think there was also a question of point to point. No, wasn't there a question? Did that get answered? I think point to point trade, isn't that what you
That's
asked?
interesting. I didn't ask it, but it's good.
Oh, okay.
It's a good question.
Yeah, I thought you did.
To avoid the watch rule.
Sure. So to elaborate on the watch rule again from a security point of view. So if I buy stock like IBM and I sell it for a loss, and then I get back into that 60-day window before or after the transaction, I have to suspend that loss because I got right back into the IBM stock. I economically bought it right back into it. So the tax rule says I have to suspend that loss until I sell the second purchase. Okay, that's how the rule basically works from a stock point of view. Also, once the rule says it has to be substantially identical, so it has to be IBM stock to IBM. So, if we replace IBM to Apple, WASA rules don't work. Okay. From crypto, first of all, my first argument is that this rule doesn't apply at all because this rule says it's from stocks and securities. The argument is that Bitcoin is not a stock security, so I don't think the 60-day window or anything applies. I could sell it, get right back into it, and I don't have to suspend my loss. Let's assume it does apply. Take the position, okay, it does apply. Now, is Bitcoin and Ether, are they substantially identical? I think you can say that they're not the exact same coin. So this is part of the argument that a different platform, different technology. What about Bitcoin to Bitcash? Are they identical? So I think those are some of the things we're gonna have to start analyzing what's identical now. I don't think so because I think a lot of these coins have different features, but that's gonna be part of the analysis of that situation. If we took that route, that this rule applies. My argument right now is that you have arguments to say this rule does not even apply at this point. But if it does apply, you have other things you're gonna have to consider.
It sounds like, what if I were speculating on currency, just fiat currency? Would I have a problem with the IRS? I need money, I'm speculating on euros, and I went back to dollars, or am I good? Do I owe them anything?
A currency to currency, you're fine.
Yeah. So I agree with you. I mean, it's but let's take this argument a step further. So in terms of exchange, right? So you probably heard about the 1031 exchange rules and whether or not you could exchange crypto to crypto and not realizing any gains and losses. My personal opinion is that if the original exchange rules, if you go back and read the original law, it was intended to be applied to real estate. That's where the law is. And kind of over the years, the courts and the system have added some exceptions to for some types of property. But if we were to look at, say, commodity rules, let's say gold and silver and some other things, there's a lot of different administrative guidance that came out from the IRS and that from that perspective. So gold is not the same as silver, and so when I look at Bitcoin and Ether, I kind of look at it from kind of the same perspective. But again, just going back, the original 1031 exchange rules were never designed for commodities; they were designed for real estate. So that was the intent of the law, original intent of the law.
So we mentioned the IRS guidelines a few times. So do you want to kind of just go over it and explain to us what it is? What are some of the parts that are beneficial or useful for the crowd to know? The IRS guidelines, I think we didn't cover, we planned to cover it initially, but
Notice 2004.
yes.
Sorry. Yeah. Yes. Sure. I think just from the perspective of Notice 2014-21 and the fact that virtual currency was declared property, a lot of what's written in there was written. It's very limited in scope application. So that's the first thing that you need to realize. But the other thing too is, the IRS really wanted to address the issues in that notice that they understood, and so when they wrote that notice, they wanted to provide limited guidance, but guidance on issues that they could clearly, provide some guidance on. So when they said, so for instance, let's take mining, for instance, activity, right? So, have any of you here in this room been involved in any mining activities? Okay, so did you design your own rig, or did you pay somebody to?
I bought ASICs from Bitmain.
Okay, so you bought a system.
Yes.
Okay, so if you're mining, that's going to be income. The activity is going to so the rules were so they addressed those specific situations in the Q&A. That's what they wanted to do. But again, when you kind of flip the side and try to get into a business transactions, it's not. They didn't go far enough. They gave us a little bit, but not as much where you could go into more detail. So,
the notice basically says that Bitcoin, it kind of acts like currency. People use it for storing value. Looks like currency, but at the end of the day, no jurisdiction basically accepts this as true currency. So we're taking currency off the table. So it's not currency. What is it? And the default to the basic rule that it's property, right? Property is the baseline for what it can be. And
So this is really dumb question. What is meant by property?
property
I know
is
what real estate is.
property is a chair, it's a car, it could be anything, right? It's just property, right? And then at that point, it's what is your intent? What are you planning on doing with this property?
Well, from a taxation perspective.
From a taxation perspective. If it's something like it's property that you're going to use, then it's personal. If it's something that's in your business, well then it's going to be ordinary, right? If it's an investment, then it's a capital asset, right? So there you start looking at, okay, it's property, now what's the intent, what's the use of it, and that's between capital, personal, and ordinary, then those rules come into play.
And property, if you look at the definition of the property, if my memory serves me right, there are 17 places in the code where the property is defined, approximately. So again, going back to what you talked about, intent, it's like you first have to determine, yeah, okay, it's property, so but what am I doing with this property? So again, like you said, intent of the transaction, what you're actually trying to do with that property, that will ultimately determine how it's going to get taxed.
I think she has a question.
Yeah.
Hi Dimitri, my name is Melanie. I have a question based on your comment about mining. So I was wondering if your perception of what applies to mining is the same for proof of stake or for other consensus mechanism where you can probably operate a master node and you get rewarded with tokens for your activities. And then the second question would be, you mentioned income tax. I just wanted to specify if it's passive income or ordinary income that you meant.
Right. So in terms of the first question, right? So, I mean, a lot of it's going to be. So, are you talking specifically about yourself, or are you talking about just a general question, right?
If it's a client who wants a code so he can put his time in.
I have vested interest in that question, so I can give you my card and we can discuss it as clients.
Right. Well, okay. So you obviously, I mean, the question is, is this an income generating activity, right? So that's the first question that you need to ask. If it kind of looks like mining activity, and again, the way if you look at the original text of the notice, they use specific examples. They didn't talk about nodes or any kind of activity that you're describing. But I would think that this would probably fall into mining activity.
So this is the very issue that John and I just talked about, because one of my clients is doing this. They're setting up a crypto fund. They said we're going to be doing noding, which again, I didn't know what that means. I had to go find a 22-year-old to explain it to me, right? Which I guess means that they're basically, when they're not using their computer and the data, then people can basically use it virtually to kind of continue. So when my laptop is sitting there and no one's using it, they'll come be able to use it. So, basically they're operating along that route. So I said, okay, well, my thought of kind of discussion with John is two ways, right? Kind of sounds like almost like rental income. Right? Then, okay, they're renting my laptop when I'm not using it, okay? Rental income is kind of what you talked about with FDAP, right? It's more like rent, royalty, interest, dividend, kind of track like that. But I could also argue that, well, as a compensation, am I getting paid a fee? It could also be considered a fee. If it's fee, then it's like mining income, it's ordinary, it's compensation. So where's the argument? So I said, this is the issue. I don't have a direct answer. I said, but I think that's where the argument applies. It could be one of those. I don't know, John, you talked about anything about that.
Yeah, I think there are just a whole variety of new sort of products and activities and ways of I think really stimulating interest in different coins and different projects. I think is really the root of a lot of this, and it is raising this question of. From a tax perspective, and some of these really important questions for some of our clients because their whole business is operated on the premise that they're going to be able to attract foreign investors in their funds really without causing these unanticipated tax issues that could potentially cause 40% of their return to disappear, and it's really unclear, I think, at this point, how you would even really sort of go about putting it in one category or the other, whether it's going to be a dividend or some kind of or interest or something more passive versus an active source of income.
Yeah, I'm sorry. Can I just so I'm I've always had this mind of actually breaking the transaction into pieces. So in your example, you kind of have to figure out where the stakeholders are, the flow of the transaction, who ultimately benefits from it, how is this benefit derived, what's the overall economics of the transaction. So those are the questions that you need to ask, right? It's like a discussion. I had somebody asked me a question, very similar question, while I was in New York at Consensus last week, and I started asking him some questions, and I started asking him describing to me what he actually was doing with his potential clients. Turns out that what he explained to me wasn't actually the case. They were doing something totally different. So I think determining facts and circumstances is really important and critical. So I would suggest that before you go to a tax professional and you ask questions, you kind of have to figure out, who my stakeholders are, what exactly the flow of the transaction, who's benefiting from this transaction, what are the steps in the transactions, what's the flow, and I think that will ultimately determine how the transaction will be treated. So facts and circumstances matter a lot.
Thanks so much.
I mean, I think if you look at the notice, right, the notice actually references Bitcoin. Back in 2014, that's all they had, right? So they never realized all these other coins. I mean, how many coins are there out there right now? Like over 1,500 or so, I've heard at this point. Keeps growing, right? And every coin has different elements, and I think that goes exactly to Dimitri's point. You can't say, this is the rule for coins. But this coin does something completely different. It has different elements. It has different features to it. How can you say these same rules apply? Well, okay, this is the rule for that coin. Well, then this coin is even different. So are you going to have 1,500 different rules because each one of these coins have so many different characteristics? I think that's the complexity. You're going to have to analyze these to figure out whether it applies or not. Like I think almost to the point right now, Bitcoin is to the point where people are almost treating it like a commodity, right? So the Chicago Mercantile Exchange and Chicago, they allowed future trading in December 2017 on Bitcoin. That gave it a real probably kind of effect that, okay, maybe Bitcoin is a commodity because now we can actually trade futures on it, right? But that's one of 1,600 coins. I don't think you can then extrapolate that onto everything. Again, this took 5 years to get to this point for Bitcoin. So I think that's going to be a complexity too, that each coin is going to have its own features, and there may be a little bit slightly different analysis. And I know there are some groupings that the industry is trying to do in these coins that may help, but I think that's going to be a huge complexity trying to analyze this with facts and circumstances. Rules that will be different for each one of these coins.
Yeah, I think may have just quickly. So I think the biggest uncertainty, just to add to what you said, the biggest uncertainty that we have is actually with respect to tokens. I think if Bitcoin or Ether or anything that looks like or has the feel of currency to it, it's a little bit easier to deal with in many circumstances. But when you get into tokens, it's a totally different ballgame because there's so many different varieties of tokens right now, and so I've actually talked to somebody last week at Consensus who's thinking about bifurcating tokens. And he tried to describe to me the bifurcation process, and I go, that is just insane what you're trying to do, but they're really trying to do that. So it's just going to add another level of complexity.
Looks like a lot is left to interpretation, right? So since it's a law and not even a law, it's a directive in a sense, right? So a lot of these folks here who are going to be paying taxes, they go to one attorney, they'll hear one thing, they go to someone else, they might hear something else, right? So at the end of the day, it really depends on how IRS interprets what they're doing, and there is a risk involved in that. So what would you say they should do to be able to kind of mitigate that risk or be prepared for that risk? What are some of the things the folks that are paying taxes should be doing? I'm thinking of. Joe, you want to do that?
If you want to talk about risk, go to the attorney.
I think a lot of people are jumping into transactions. I see some lawyers out here nodding their heads because sometimes they say, well, look, the money's out there ready. I have no choice. I have to go ahead and do this. Which I guess is one way of looking at it. Sometimes it turns out that that's the more painful path. because I think I'm predicting that at some point I'm going to be advising people on the tax consequences of returning cash in a different year from the year of receipt. A pretty strong feeling that that's going to come up in my practice at some point. And that's a pretty complicated tax question. In general, I think one of the big themes of this area is there's an enormous risk of having a tax bill and no cash to pay. And I'm also predicting that I'm going to see some of those cases as well. And so, yes, I do think that it's an area where you definitely want to be careful not to jump into things where you're just going to create a big liability without even really knowing what happened.
I'm going to add the fun facts that happened to me. So about 3 months ago, a client of mine called me and she said, "Does IRS accept Bitcoin?"
Arizona does.
And I said, "Unfortunately, no."
Who does?
Arizona.
The state of Arizona?
Yes.
Yes.
To pay taxes.
So, so you talk about taxes and you talk about Bitcoin as property. Can you also comment on like-kind exchanges for tax purposes?
So I think you should talk a little bit about the like-kind exchange. So the first rule kind of knows that the new tax bill that was passed in 2017, I think pretty much killed it for coins because it exclusively kind of went back to what Dmitry said that like-kind exchange rules should really only apply to real property, okay? So if you want to take the position that like crypto to crypto, it was a non-taxable event, you basically get one bite of the apple for 2017 taxes, and I think that's about it. The argument's dead going forward from that perspective. I do think there's a bill out there, though, they're trying to pass, and I don't know where it stands right now, where for transactions between, let's say, coin or any kind of transaction, less than $600, they'll just say it's de minimis, non-taxable. Well, right now, where crypto is, so if you go, if you want to get into an ICO, and most ICOs either accept Bitcoin or Ether, right? You can't get in with fiat currency. When you give your Bitcoin to get that ICO token, I think that is a taxable transaction to the recipient. They're going to have to pay tax on that. That coin-to-coin is a taxable event.
And I'm actually going to go on a limb and say that if you've done the exchange, even 2017 or prior, chances are if you get audited and you're doing crypto to crypto, that the IRS will say it's a taxable transaction, even before the change in the tax law. And the reason for that is, again, I go back and you could look at the evolution of the code from '86 and some exceptions that were made for commodities. It's again, you go back to comparing gold and silver and some of the administrative rulings that came out. I think it's very hard for me personally, knowing what I know about crypto, to say that it would, in most cases I would go on a limb and say it probably wouldn't qualify. But it's just my own personal opinion. So.
Yeah, I see it slightly differently. I mean, it's interesting the way you phrase the question. If you're audited, I think at that point that IRS made a decision. They think it's taxable if they're going to audit you, and they're not likely to give up on that. They would probably take it all the way to court, and appeals. But that doesn't necessarily mean that they're correct, and it also, I'm not sure that they're going to actually do that, to be honest. I don't know that it's really important enough to them, or that they've even necessarily made a decision. I mean, I know that they've considered the issue, and they haven't released any guidance. But it's just a purely historical question. So it's a question of like, are they going to actually devote the resources to auditing people who've actually reported their transactions on the return and gone through the trouble of doing that? I mean, it's possible, but I could also see them saying, look, it's just a historical question. It's not something we're going to devote our resources to, and it's not an unreasonable position, because if they just thought it was just fraudulent or patently unreasonable, presumably they would have issued some guidance telling people that.
So you mentioned token sales, and that was a perfect segue into my question. So let's look at token sales from the actually I'm not even going to call them issuer, from the token seller perspective, right? So somebody is selling tokens in the initial token offering. They may be secured, they may look like securities, they may look like utilities.
Let me give you a mic because I think we
Oh,
will record this with
sure.
a video.
I can also speak up. Thank you.
Dimitri,
I was asking about token sales from the token seller perspective. So the company that sells, or the entity that sells the tokens, do you look? I know that there are different types of tokens, and we don't have clear consensus on what they are. But in general, like, do you have a view of whether that's should be taxed as an investment or as income for selling goods and services? Do you have thoughts on that? That's kind of part one, and then part two. Let's complicate it a little and say that this is a decentralized organization, not a company selling tokens. So how does that change things? Thank you.
Yeah, so let me take on the first one, because let's just say it's a blockchain company. You had an ICO. Let's say it's a corporate entity, right? So most ICOs out there, and I think if you look at the 340 ICOs that we had in 2017, they all tried to make the tokens as utility tokens. In fact, I would even say there have been some plagiarizing in the white papers, because everyone tried to more or less say the same thing in the white papers and say, oh, it's a utility token. So going back to notice 2014-21, right? So we know the virtual currency is a property, right? So you sold property in exchange for the right to provide, you've given somebody a right to receive services. Let's say it was a service-related token. You basically say, a year from now, 2 years from now, when our business is up and running, we'll give you this. We'll give you this type of service. So because it's a property, it's, that in this case, this would be a taxable event. And I guess the question here is there a mechanism that would allow, if it's a service, can it be deferred for a year, right? So again, you have to go look at facts and circumstances, because there's some tokens that actually would give you either a product or a service, or maybe just a product. So there's also an issue as to, have you actually had a constructive receipt? Have you actually received the token? Because in some ICOs actually held back the tokens, you didn't get them immediately. So it's sitting kind of like out there in the escrow account. So you're gonna get it, but maybe not immediately. It will take 6 months to maybe in some cases 9 months to get it, and then you have this new period for So if it's I think because it's a property, it would generally be considered to be a taxable event. It would be taxable to the company, and that's the reason why a lot of the ICOs, we're kind of backwards, because most of the companies that have gone through the ICO, they looked at it as kind of an equity raising event. And I think for those folks that are investing into tokens, they're looking at it more from a speculative investment type perspective. So I'm investing into something that hopefully will go up in value, right? But we're kind of back to 100 years ago in terms of analyzing the transaction. So I think it is a taxable event. So the other question.
What about securities? What about the ones who don't pretend and say they're sell securities? With
Right.
equity-like shares.
So
like
I've actually shared my, it's not really a joke, but the mentor of mine used to say, if you see a wagging tail, it doesn't mean there's a dog on the other side. I know it sounds funny, but what I'm trying to say is that if a Securities and Exchange Commission said this is a security, it doesn't necessarily mean it's a security for tax purposes. You got to look at the substance of it.
Yes, but a lot of them are selling the securitized assets, the tokenized security-like assets.
Right.
So they're pretty honest and open about. It's not even about the SEC. They just say we are selling securities.
So let's there's been a lot of discussions in the last, I would say, 6 months, and I think some of the ICOs that you'll see in the next and I'm speculating right now, I think some of the ICOs that you'll see in the next 6 months to a year, they'll try to go the route of Reg A plus, Reg D, and maybe even an S1. So there'll be an attempt to securitize the token, if you will, and I'm using this term very loosely. And you'll see some of those tokens will be pretty wild because they'll look more like they'll have embedded derivatives, they'll have options, they'll have warrants and things like that. So it can get pretty complicated. I think, given the right structure and the right facts, I think there's an ability to get there. But again, it's going to be very, very factually driven, and because you could have a situation for tax purposes where something could be deemed to be, for regulatory purposes, would be deemed to be a security, that or equity, but for tax purposes still be taxable.
The second part was about decentralized organizations.
Go ahead, and I'll answer that question.
Yeah, I think it does raise a good point, though, because it's certainly true that I think sometimes people conflate the technology with the taxation, or sort of merge the blockchain technology with the taxation of, say, Bitcoin, and it's just simply not the case. I mean, just because it's property, it doesn't mean that it's that all tokens are the same type of property as Bitcoin. I think now we sort of understand how Bitcoin is taxed more or less as much as anything. But if someone creates a new type of token that is essentially stock of a company, that's going to be, I have no doubt, that is going to be taxed as stock of a company. And that notice for Bitcoin is completely irrelevant to the taxation of that token. And has nothing to do with it. So yeah, there is a tendency to say, oh, it's a token, therefore the notice tells us what to do. It's just not the case. You have to look, and I think this is what Dimitri is talking about, you have to sort of understand what does this token actually represent, because that's what that's how our tax system works. That's the question is not can you trade it on the blockchain, it is what are the features and rights associated with this property. That's how we're going to understand how to tax it. And I think there certainly will be equity tokens, there'll be stock tokens, there may be partnership interest tokens that are going to be units that will be issued. And I don't think there's really a whole lot of question about how those will be taxed.
I think before we go on, there was some decentralized organization question in there. Do you want to just quickly address it? Because since we already covered it.
Yeah, I mean, I actually get this question all the time about, because I've spoken to a number of people while I was at the conference, and so before I get to your question, let's just talk about the important stuff, the stuff that really matters. Because we all have dreams and we would like to make the world a better place to live, right? And if you go back to, the ecosystem and the original ideas, a lot of people wanted to do certain things and they wanted to develop the technology and make it available to the world. But there's always a little profit motive here inside. We all, if we were all independently wealthy, I think we'd be doing all kinds of things, good things for the community and the world. But the question I always ask for those folks that are involved in this is, say, okay, well, you're going to have a hedge fund investing a significant amount of money into this venture. Where is the IP? What technology are you developing? So if everything is out there being developed by the community at large, what do you actually have when it comes to your company? Yes, you've given away 75% of your ICO, to the developers out there that are developing a platform for you. You've got this nice tax-exempt foundation that you set up. Well, gosh, you just realized that the Cayman Islands changed their law and came up with this new form of tax-exempt entity. Can I be treated as a tax-exempt organization? well, substance versus form. If your entity looks like and acts like a corporation, forget that you set up a tax-exempt entity, right? So.
Cool. So you want to go? Did you have the mic, and then we'll take one last question.
So you've talked quite a bit about Notice 2014-21, and including in the context of an ICO. I wanted to get your views, though. Notice 2014-21 applies to convertible virtual currency, and so query whether at the instant of an ICO you have something that is convertible. Whether, given that in many cases tokens are not traded on an exchange for months, if ever. And so I'm just curious if you take anything from, it says convertible virtual currency is property, it's not currency, period. So do you, and you've talked quite a bit about, there are certain things that clearly fall outside of the notice. Do you view things right the moment they're born in an ICO as being covered by the notice, or do you have concerns about that as well?
Okay, so let's look at the transaction, right? Let's say let's look at the genesis of ICO and the flow of let's start from the very beginning. Generally when you go through the tokenization process, or you start, let's say that you've got it's pre-ICO activity. You're going to give some of those tokens to your original founders, right? If I'm the founder of the company and I'm getting a token, I have this perception that whatever I'm going to receive has some value embedded into it, right? I'm getting a piece of property, it's property, right? And I feel that if I'm getting something, especially if I'm getting something free, right? Let's say I'm a founder, I'm a contractor, I'm somebody there that performed some services for the company, and I'm going to extract some value from it down the road, right? So there's going to be some value attached to it. It may not be, it's probably not going to be a zero. It's like an argument I had with a client many years ago who was trying to tell me that the warrants that he had received were worthless, and I said,
give them to me.
Give them to me. That's exactly what I said. So I said, if you receive those warrants, in this example, that means that 4 or 5 years down the road, or much sooner than that, you're going to get much more than nothing. So if there's some value attached to it, and you got it now, then it's going to be a taxable event.
I think we have a question here. We'll get to you in a second.
I have 2 questions. I have a client that sold Ethereum and Bitcoin and would like to use specific identification, or LIFO, as their matching method. But because there's no way to identify this specific ID to the exchange before the trade settles, can he use specific ID, or is he going to be thrown back into FIFO, which would maximize his gain? And then the second question is, have you found any portfolio accounting software that can handle a lot of margin trading and transfers between the various exchanges? Because I'm having a heck of a time trying to account for this stuff.
I can talk a little bit about this. So, yeah, my client had the same issue when they started investing this a few years back, and they're out there buying millions of them, and they couldn't even buy that much. So they get $1 million to buy Bitcoin. It would take them about a month to buy that many out there, right? And so they had all these fractional pieces there. Then the real issue came to how do we figure out our cost relief method. Very complex, because the reality is that one is that you're not going to get good record keeping from your exchange, right? They're not going to give you a 10 broker report or anything like that. You're not going to get that. Specific identification, we typically use that in security world, but much more easier to apply. At the end of the day, from the cost relief method, I think at the end of the day, most of the reporting is going to be self-reported. You're going to have to go, the onus is on you to figure this all out and what you're going to deal with. My approach has been usually that you have to end up having to find some kind of reasonable approach, a consistent approach, and that's probably the way you're going to have to do it, and to work out what your cost relief method is going to be. If If you can do specification, that'd be great. Otherwise, you might be defaulted into FIFO because that's just what you can end up, the only methodology you can use. You can track on your own to do that. I know there are technology companies out there trying to solve this answer. In fact, I've known a couple of firms even came to EY to pitch their system that they have out there. Very kind of rudimentary, elementary right now. But I think people are realizing this is a problem and they're going to do a better job. I think the exchanges are trying to do better reporting. I think Coinbase now has some kind of reporting mechanism that they're kicking out. So I think the exchanges themselves have to start getting a little more sophisticated as this world grows to help the investor along. But right now it's complex and mostly the onus is going to fall on you to kind of really figure out that cost relief method.
I mean, I don't know. I've had a lot of clients who use Bitcoin.tax. I have no affiliation with them whatsoever, but they seem to like it. I don't know if you've tried that yourself.
Yeah, they didn't seem to handle margin trading in a lot of accounts.
Yeah, I think that
transfers between the exchanges.
Right.
That's,
yeah, and I think you're right about margin trading. Although I think you can tease it out. But and I also I think the comment about reporting. I mean, it is sort of interesting to see. I think Coinbase is just embracing reporting voluntarily because they just don't want to be involved in litigation. You know, they don't want to. That's not their business model to be litigating against the IRS. So that. I don't think it's required. I think they're just doing it because they're just embracing it.
To help their investors, basically.
And also to help their investors.
One question we haven't touched tonight is we have heard a lot of news about exchanges or personal accounts being hacked and the cryptocurrency being stolen. How do you deal with that sort of thing for your taxes?
Sure. I mean, that is actually a question one of my clients and I discussed more in theory than anything else. But the issue then, because his coin is that I have some of my coins in cold storage. And what if I lose that laptop? I said, okay, well, what are the tax rules that are out there, right? Is it worthless? Well, no, it's not worthless. It's still being traded out there. Was it theft? Well, no, that's another theft loss that I could claim out there. Is it abandonment? That's the other kind of concept out there to take the loss. Well, it wasn't really abandonment, right? You didn't truly, give up all your rights to it. So it becomes complex, I think, at that point because you have these coins that are being traded out there and you just lost the flash drive and how do I deal with the loss and how do I claim it under the existing rules that are out there right now? And those are typically the big three that are out there, right? The abandonment, theft, or some kind of casualty or it become worthless, right? So it's a complex issue, I think, at the point because it doesn't really quite fall into any of those categories. And I'm not really sure there's a definitive answer on it. I think abandonment is probably your closest argument to say that at the end of the day, I'm going to relinquish on ownership. But let's say you end up finding it, a year or two later at that point. What do you do with that?
More meant like, the exchanges themselves get hacked.
There is the ability to take a theft loss. Yeah. That rule is out there. So I think that one, you can probably claim theft loss was out there, as casualty loss. So there are limitations to the practicality of how much you actually get out of it. Well, there are rules around that piece of it. But I think this is the more unusual fact. But there are rules around the tax side on being able to claim something from a theft loss of my property.
I think we'll have to wrap up pretty quickly.
So, and just to interrupt a moment, on the theme of that, we've actually got a crypto security panel here on the 19th of June, and I actually have landed David Hussaby from Hyperledger, who's like a top security maven. So if any of you are interested in coming to that, please put it in on your calendar. But sorry.
So by now, I know there are a few more questions out there. I think the panelists are going to be around later on. So thank you. This is very interesting. And I'm just glad that nobody asked about tax evasion. So really thanks very much.
Thanks. Please give them all a hand. And before we finish up, sorry, I have to introduce Tobin Doma, who's actually our FinTech attorney here at Shepherd Mullen. He sponsors a lot of our events, and I know that if you've got any questions about legal issues regarding this, Tobin's the guy to contact. He's a very nice guy. Thank you, Tobin. Okay, so we've got